The stock market to GDP ratio. Warren Buffett calls at any given time, the most accurate measure of valuation. Now, of course, there's a lot of people out there, they're going to say, no, it doesn't count anymore because so much money is generated overseas today versus GDP and GNP are within 1% of each other. But I get it. So we're going to look at two things today. We're going to look at the stock market to GDP ratio and the 10-year cyclically adjusted PE ratio. Okay, what does that mean? Well, the first one is we take the entire stock market cap and divide it by GDP, because as a country grows in GDP, the companies within it should also grow. For the second one, the 10-year cyclically adjusted PE ratio, it takes the earnings of the last 10 years of the S&P, brings it to today in today's dollars with inflation, and says, where is the market selling? Okay. Now, in our community, every single day, at the end of every single day, I post where the GDP and the PE ratio are, going back forever. I do it every single day. So let's say, for example, let's go back to January. Let's go back to the beginning of the year. So January 3rd was only the stock market GDP ratio. We were at 60.5% overpriced and a ratio of 1.5. Now, I want to explain to you how I come up with this ratio. I don't take the entire stock market GDP. To me, what matters is I just want to take the ratio of large companies. So I took the S&P 500. I went back to 1929. Or the equivalent of the S&P 500 going back to 1929. And I went back and did GDP back to 1929. And this is what I came up with. I went all the way back here, 1929. There's every single quarter going back. And I sat there and looked and said, okay, I looked at historical average. Are we overvalued, undervalued based on historical average? The overall average for this metric on the stock market GDP is 0.92. That means if you take the S&P's market cap divided by GDP, it should be roughly 0.92. We are currently at 1.64 as of this morning. Back on January 1st, according to our community, we were at 1.493. So it makes sense. As the market goes up, the ratio goes up, but also as GDP has gone up, the ratio will go down, right? So GDP has increased significantly in the last 3 or 4 years. Before COVID, GDP was about 21.7 trillion. It's now 26.8 trillion. That's a big jump. Why? Inflation. Inflation has really helped jump up GDP. The government giving everybody a bunch of checks, that's helped increase GDP significantly. That's helped out a lot. Fair value right now on the S&P 500, according to this ratio, is about 2,500. So you might be thinking to yourself, oh my gosh, I've got to sell. No, just understand that there could be a lot of volatility in the next 10 years. Now, this is what I do. I go and say, okay, based on where we are today, how do the next 10 years look according to the stock market GDP ratio? So going back to history, this is not including dividends. The average 10-year return is about 6.6% per year. That makes sense. Add in 2 or 3% for dividends, you're about 9 to 10% in terms of total return. When we're over 50% overvalued, the average, the 37 times that's happened in the last 70 some years, 100 some years, almost 100 years, is negative 0.5%, not including dividends. And guys, as it's less and less overvalued, look at the returns. They're increasing. It makes perfect sense. Now, of course, people are going to say, oh, gee, and this is what I hear at every market top. Well, the stock market GDP ratio doesn't work anymore. Fine. So then I say, let's go look at the 10-year income, the 10-year PE. Why? Because the earnings on the 10-year PE will include all earnings of the S&P 500, no matter where they receive the profit from, whether it's in the US or overseas. So I have another sheet right here. The average 10-year cyclically adjusted PE ratio going back to 1929 is 17.0. Okay? Where are we currently? 30.85, which is 81.1% overvalued. Higher than the stock market to GDP ratio. Higher than that. Now, can this all end up okay? Sure. It can all end up okay. By the way, don't look at this date. I haven't updated this date in a while. This is the 30.85 is as of today. This can end up being okay. How? Well, earnings just all of a sudden skyrocket. Earnings double, we're all good. The GDP skyrockets, but you can't see an increase in the stock market value. You can't see the S&P increase in order to get that. And what's more likely to happen is, in my opinion, GDP goes up S&P goes down, and that's how you get, and same with earnings. Earnings go up, S&P goes down. That's how you get it to go back to normal. Now, should this scare you? No. It should worry you if you're close to retirement and a big chunk of your money, if not all of it, is invested in the stock market. Be ready for a lot of volatility. But if you're 10, 15, 20 years away from retirement, actually more than 10 years, 15, 20 plus years away from retirement, this should not worry you at all. It's just to tell you, listen, don't be surprised if there's a lot of volatility and you don't get much return in the next 10 years. But you can still make great money by buying every single month, quarter, year, etc. Dollar cost averaging will allow you to ignore the fluctuations that are happening. We want you to ignore those things. And as stocks fall, you keep buying. As stocks rise up, you keep buying. The mistake I made years ago was saying, hey, we're at 23, 24, 25 times earnings on the 10-year. And apart from the .com, it's never been that high. We're probably not going to hit that again. Boy, was I wrong. Look how high we got. We got very, very high here. 38.58 was our high in November of 2021 for the 10-year PE ratio. 38.58. That's a big number, guys. The current corporate profit as a percentage of GDP is 10.3%. The historical average going back to 1950s is about 7.1. So we're still higher there. Now, is there an argument to be made that today the service industry is a bigger piece of the economy than manufacturing and therefore profit margins will be higher? Sure, understood completely. But at the end of the day, it's still a return based on money invested. And if you expect a higher return just because of the service industry, I don't believe that's going to happen. Can you expect a higher multiple as we become more service oriented? Absolutely. But at the end of the day, it's still going to look at, the thing that I'm going to look at is, where's the current risk-free rate? The 90-day treasury is paying 5.5%. That's a very high number. A year and a half ago, it was zero, essentially. So now you can put money in a bank account and the 90-day treasury is making 5.5%. What premium do you need in order to own a stock? And right now, according to this, the 10-year return is negative 0.5 projected return on the S&P, according to this. Guys, everything's about risk reward and also opportunity cost. If I tell you today, hey, invest in my company and I'm going to give you a 7% return, your response should be, why should I take that risk? I can go give it to the government for 5.5%. I can give it to the government for 10 years for 4.3%. Why would you ever take the risk of having your money go to zero and to get 7% when you can give it to the government for 10 years for 4.2%? Those are the things to consider as being an investor. That's what I want you to learn on this channel. How do you sit there and evaluate different investments? Let's give you an example. 2 years ago, a friend of mine called me and said, hey, I have a friend of mine trying to raise money for a real estate deal. Give him a call. It might be up your alley. So I called the guy. I said, okay, what's the deal? He's like, hey, I have this vacant piece of land I want to buy. It's going to do X, Y, and Z, and I'm giving a 10% return. I just laughed and said, not interested. He's like, 10%? Right now you're getting 0%. I'm like, yeah, but I have my own real estate. I can go invest in my own real estate making 15% returns. Why would I give somebody else money in a deal I can't control for 10% when I can invest in my own deal for 15%? That's my situation. I have businesses upstairs, 5, 6, 7, 8 businesses I can invest in and get a higher rate of return than 10%. Now that's for me. That's for my situation. So it works for me in that regard. But I recently raised money for a debt offering where I offered 8% return. You might sit there and say, wait a second, you gave 8%, but you're not willing. Yeah, because the people I appealed to were people who 8% to them, they knew me very well. They knew I was going to pay. 8% was a lot of money. They're like, hey, I'll gladly do that. I trust Paul. So it's always about analyzing those things. But overall in the market, you've got to remember that if you're going to pay 30 times earnings for the last 10 years of profit, that's a 3% yield. Is that enough for you? Well, of course it could be if you knew that profits were going to grow like crazy for the next 10 years. But if you thought profits were going to be the same or a little bit lower, is 3% enough for you? And that's why I look at these ratios. That's why I want to sit there and understand that, hey, things can be a little volatile for the next 10 years. Remember, it's funny, we talk about COVID. COVID occurred and the market fell 40% in 1 month. And my comment was, COVID was the excuse. Because guess what? The market bottomed and rebounded and started to rebound when we only had 5,000 or 10,000 cases in the country or something like that. Somebody can verify that for me. I look at that saying, was it really COVID or was it overvaluation and people's excuse to sell? As John Hussman says so brilliantly, in a room filled with gasoline and a fire in the corner, I don't know which spark will cause the explosion. All I know is there will be a spark that causes the explosion. We look at the recession right now. The 2-year and 10-year have been inverted for a while. Now, we did a video last week where we talked about this, saying, hey, in history, it sometimes takes 11, 14, 15 months before the recession starts. And somebody in our office, Tim, just said to me, hey, do you think we're going to avoid recession? I said, no. And I don't believe that if the government comes out and writes checks and the economy still grows, that we avoid a recession. We just sat there, Mo's sick today. I sat there and said, just because his doctor gives him medicine that hides his symptoms doesn't mean he's not sick. I'm not trying to be Debbie Downer and poop on the U.S. economy. I'm a big believer in the U.S. economy going forward. But it's okay to have recessions. All I know is that our unemployment rate is very, very low right now. And that's an inflationary matter. And right now, inflation is an issue. Core inflation is still over 4%, and the Fed wants it to be at 2%. The only reason overall CPI is lower than 4% is because food and energy prices have really fallen, but they're starting to creep back up again. This is all looking at it together to get one point across. There are so many metrics that drive an economy. Take the thinking out of it. Just invest in a low-cost ETF. But if you feel like you have what it takes to buy individual companies and you have the emotional fortitude to see those fluctuations, this is the channel for you. Thank you very much for your time.